To build anything that truly lasts, it takes time.
Good evening. Welcome to the Money Show, where we answer all your financial questions and change the way you look at money. I'm Kavita Thapliyal, and this show has information that can completely transform the way you handle your finances. Have you ever wondered where your money is really going? Have you ever stopped to track your spending? And do you know that with the right financial decision, your life could look completely different? So in this show, we explore how small changes in your financial habits can lead to big rewards. We tackle questions that directly impact your financial well-being. Can the right use of credit cards help you achieve financial freedom? Are you investing your savings wisely, or is your hard-earned money slipping through your fingers? We'll also be sharing tips on budgeting, saving and managing your money effectively. And if you've never focused on your financial planning, this show is for you, because we also answer your portfolio queries in this show. Just in case you want to send across your queries, you can do that on our WhatsApp number and email ID that will be flashing on the screen. 865-797 4571 is the number where you can send across your questions. Our WhatsApp number, themoneyshow@etnow.tv, is our email ID where you can also send across your portfolio details. But then let's move on. And today, the focus on the show is if you're an investor looking to build a more resilient portfolio, understanding business cycles is essential. But what if we tell you that you could capitalize on this economic cycles with specific funds designed for just that purpose? So today we'll be talking about Business Cycle Fund, the investment strategy that attempts to align your portfolio with different phases of the economy, from expansion to recession. Every business cycle has its unique characteristics, and knowing when to invest in which phase can significantly impact your returns. But how do business cycle fund work, and are they the right fit for your financial goals, and can they truly offer stability and growth during period of economic uncertainty? So let's begin a discussion. And today we'll be talking about Kotak Business Cycle Fund, and I have with me Harish, Biyani, EVP and Fund Manager, Kotak Mahindra AMC. Harish, hi. Good evening. Welcome to the show. So clearly, Kotak Business Cycle Fund is the focus today. And the fact sheet really mentions active allocation-based economic cycles, based on economic cycles. I really want to understand the recent decision on rotation that illustrates this strategy in action. How are you currently allocating, between large, mid, and small cap or other cyclical sectors? What is the rationale behind the current portfolio and the current positioning that you have in the portfolio?
Absolutely. So as you rightly pointed out, Kavita, that this fund, we try and look at where we are in the business cycle. Within that, we try and identify 5 or 6 sectors where we allocate 85 to 90% of the portfolio. So you have to get the sector or the theme right, and you have to get the stock calls right for the overall fund to do well. At present, we are overweight the healthcare sector, which to our mind is an evergreen sector, especially the domestic facing hospital, diagnostic, domestic pharma names that should continue to do well, both in the near as well as the medium term. We have also gone significantly overweight the consumer sector. And when I mention consumer here, it is not consumer discretionary. It is not consumer staples. It is more of consumer discretionary. Consumer retail sectors, consumer durable sector, which we think should do well given the tax cuts and the more money in the hands of people, interest rate cut. And third is the pay commission hike that we are expecting. Over and above these, we are overweight the auto sector, the industrial sectors. We have reasonable weightage towards the financial services sector, so as to ensure that we participate in the right sectors and the right companies for the next 12 to 24 months.
Let's move on. And you've also stated that this is a bottom-up stock picking fund guided by macro. Now, how do you balance between the conflict when bottom-up signals contradict your overall macro view? Because that's the main focus, and that's the kind of strategy one really adopts in a business cycle fund. So, constant contradiction and volatility also in macro fundamentals, that might also impact your strategy, your bottom-up strategy. So, what do you have to say on that?
Sure. So first is that we have to get the sector and the theme right. Once we get the sector and the theme right, then we try and identify individual companies on a bottom-up basis that should do well, given the theme and the sector is going to play out well over the next 12 to 36 months. So it is a bottom-up strategy, but with the overlay that you have to get the sector and themes right, which is what we have seen traditionally across the market cycle, that once you get the theme and the sector right, and the overall construct of the portfolio gets easier. Obviously, you have to get the stock calls right. Within that, we also, as you pointed out, that we try and have deeper understanding of where we are in the business cycle, economic cycle, behavioral cycle, earning cycle within the entire theme and within the entire sector that we are looking at.
Get a conversation on the sectors aspect of your portfolio. Currently, I want to know which are the 2-3 sectors that are driving alpha generation, because that's the main motive anyone would want to have this fund in their portfolio. And are those sectors likely to sustain performance in next 6 to 12 months? Because the way we started this particular calendar year and now where we are, there is a complete contrast with what we expected and what it has turned out to be. But it's quite natural also, because the triggers were definitely out of a control. But having said that, again, the same question, 2 to 3 sectors which will also do well in 6 to 12 months. So, yeah, what's the answer?
Sure. So our alpha generation over the past year and a half has been driven by the healthcare sector, some of the consumer names, some of the industrial names that has done well for us. And we think that some of these sectors are going to continue to do well in the next 12 to 24 months. We are increasingly looking at more allocation towards the financial services space, given the interest rate cut. There are more bottom-up opportunities over there, both within the private and the public sector names. So we are trying to work deeper to understand which particular sectors, which particular themes within the BFSI sector will do well over the next 12 to 24 months.
Also, what happens is a lot of time, because you're a fund manager, you also take calls and, try and figure out different strategies in your investments, in your portfolio, in your fund exposure. Could you share examples of stocks that were added or dropped recently due to changes in your reading of the business cycle? Because microenvironments have really changed. What you actually got wrong, where the timing went right. If you could just share something with our viewers.
Absolutely. You're right in pointing out that we as fund managers makes mistakes. We have to, on average, get 70% of the portfolio right, so as to ensure alpha generation for the portfolio. So within that, there are specific pockets, specific names across sectors where we would have made a mistake. It would have been a mistake of understanding the nature of how business is going to evolve over the next 12, 24 months or a little longer. And sometimes there are uncertainties which comes our way, which is a known unknown. There's something which we could have looked through. Nonetheless, it was significantly in future, but kind of got much in advance. So one of the names that we had was one of the auto companies. It was doing fairly auto ancillary company. It was doing fairly well over the past few years. This particular year, they were double whammy of the export slowdown combined with the fact that they have a fairly large volume which goes to the US market. US market A itself could slow down, and B, there's a large tariff looming over a lot of these auto ancillary players who will supply to US. And there's a third factor where there's certain particular portion of the US export which is prone to cyclical slowdown that we are seeing over the next 12 months. So as we pointed out that this particular fund, we have to ensure that the next 12 to 24 months in terms of earnings, cash flow, return on equity should be improving, which was clearly not the case over here. So we decided to part ways with this particular name and got better names in the portfolio that should help us generate alpha for our investors.
Uh, Also, one thing about the fund, it's a relatively new fund. Now, without a long-term track record, how should investors evaluate it? Because what is happening is a lot of AMCs are launching business cycle fund. If you cannot have this as a part of your core portfolio, when should you be having it? And what is the right time to evaluate, with respect to having this fund in your portfolio? How can one go about it?
Sure. Now you will have a reasonable history of more than 2.5 years. Uh, the f- the the thing is fairly clear that whatever process that we have communicated to our investors, are we following that every month? If you follow a systematic process, a process that has longevity, a process that has worked across the cycles, especially when you're looking at multiple business cycles over the next 5 to 10 years, if that is continued and that is based on a lot of work that we have done in the background to understand how things happened in the previous cycle, why it happened, and why it should continue. So, as long as the process is right, the outcome will follow in the long term. And we as a house at Kotak strongly believe in process oriented fund management. We do not believe in individual based fund performance. So, individual might come and go, but as long as the process is stringent and you follow that process consistently, the longer term outcome should be good over time, according to our understanding.
Let's talk about returns because that's a very crucial aspect of having any fund or any kind of investment in your portfolio, right? So now since inception, I want to know how has Kotak Business Cycle Fund really performed against the benchmark and what contributed most to outperformance or underperformance of the fund. Also because we're talking about a long-term strategy, I believe more than 3 years or 5 years you would want to be in this fund. What exactly should be a long-term average return expectation? I know you cannot talk about returns and you cannot talk about return expectation, but looking at the performance now, what would you recommend?
Sure. So, Kavita, I took over the fund about a year and a half back. We've done reasonably well over this particular period. And reason is the sectors that we discussed, some of the sectors that I introduced in this fund, especially overweight and healthcare, certain specific consumer names, specific industrial names, have clearly helped generate decent alpha. And we think that as long as we focus on ensuring that we have the right sector themes with high earnings growth over the next 12 to 36 months and rolling, which means that all else being equal, the outcome should follow. So market clearly chases earnings. So as long as you get the earnings call right, the outcome should be fine over time.
Harish, one more thing, this fund runs the risk of misreading economic phases. Now, very important aspect is the risk that is involved in investing in this kind of a fund and risk involved in investing for you also as a fund manager. Now, what safeguards do you have to avoid being on the wrong side of the cycle for too long? Because misreading economic phases is quite unpredictable. And being a fund manager, you have to factor all of it when you are deciding the strategy for your fund, when you're deciding the exposure for your fund. So, how do you take all of this into account?
Absolutely. So, Kavita, you rightly pointed out that there's a risk that you get the sector theme wrong. So, in this particular regard, what we do is that there's an investment committee meeting every month where there's threadbare discussion on how the overall business cycle is performing, how the overall sectors are performing, and which sector should a fund manager focus on. So that overlay is there where the top management of the company is involved so as to ensure that we do not get the theme or the sector wrong. Then it is left to the fund manager to identify individual ideas within those sectors and themes. So there's a clear overlay on how it is structured so as to ensure that mistakes are low. And even if you make mistakes, you can rectify that fairly quickly.
Harish, as an investor, if I want to understand, are there internal limits on sector exposure or drawdown thresholds that trigger a relook at your location strategy?
Not necessarily. Like we clearly have sector limits in the sense that we'll have six sectors, which will be 85 to 90% of the portfolio. In this particular fund, we are benchmark cognizant but benchmark agnostic, which means that we are aware about the benchmark, but we clearly do not follow the benchmark. If there's a particular benchmark where we should be a particular sector where we should be zero, we'll be zero. There's a particular sector which we have to be significantly overweight, will be overweight. so as to ensure that we're taking the right call for our investors without getting too bogged down by what benchmarks are and how it is going to behave. So clearly a limit on how on the six sectors which is being focused by the investment committee. On these stock specific uh, weightages, we again have a clear mandate within the fund house in terms of various categorization of A, B, C, D, which is being followed. There are some internal limits which should be followed for every specific stock, so as to ensure that the risk is minimized while focusing on long-term returns.
All right. Would you recommend this fund as a core holding or a satellite one in an investor's portfolio? What would be the reason behind the placement that you are recommending, and what should be the minimum holding period that you would advise investors? 3 or 5 or more than that?
Sure. So while we think that this particular fund, as we identify the right business cycle and within those the right stock picks, somebody who has a time horizon of around 3 to 5 years should look at this particular fund. The fund manager and the fund house ability to identify right sector themes and within those companies seems fairly decent when you look at the past history of how Kotak as a fund house has done. And with that, hopefully, over the longer term, we'll be able to do justice to what we have been able to achieve for our funds historically. So that is where we are.
All right, Harish, with that, it's time up on the show as well. Thank you so much for taking time out and helping our viewers understand not only just your fund, but also the way this category works. Thank you so much.